Hi everyone, it's Cherry Chen from Real Estate Tax Tips again. Today, I'm gonna go through the this new article that I saw on April 11th that got released on April 11th. I thought it's very interesting because it's all about the red flags that would trigger an audit. Um, this writer wrote about the recent development on CRA's audit, and one thing that I didn't even know myself was that CRA actually did some focus study in the past. They in 2010 and 2011, they did some sort of an analysis on their end that they and analyzed the result from conducting random audits and check on whether these people are having any non-compliance. They realized that there are only about 12.2% of the case that would have non-compliance issue. But if they use a target approach, meaning that they focus on a specific group of people, they and identify the high risk area and focus the audits there, they have found that they could increase the audit result, finding the audit result, finding the non-compliance a lot higher. So the resulting effort, like essentially using the same effort, you can find 46% of the result of the cases that are being targeted have non-compliance issue. Whereas if they do a total random audit case, they can only find 12.2%. So that study happened in 2010 and 2011, and that arguably before I started my practice. But I thought it was interesting because then that means CRA is going to focus on the high risk area, which I've always told everyone that CRA has been focusing on the real estate transaction because real estate has been the one that's making a lot of our investors, clients money. So they wanted to make sure that you are doing it right. This author, the Global and Mail article also suggested a few characteristics that would pinpoint the high risk area. One of it is you've sold real estate, surprise, surprise. And then another one is that your income doesn't match your postal code. I thought this one is interesting. There are many court cases that CRA would use a net worth approach. Like for example, you're living in the Toronto Bridle Path, but your income tax return is reporting like $20,000. It doesn't really make sense. Those are the red flags that CRA will look at and essentially say, hey, like there must be some unreported income that you are earning you're earning outside of your tax return that allows you to purchase such an expensive home. I'm talking about Bridle Path in Toronto, and it's one of the most expensive, prestigious street in Toronto. Houses there are millions and millions of dollars. So if you're reporting only $20,000 a year, unless there is a legitimate reason for it, it's hard to justify supporting that type of a house. Now, and then the third characteristics for being selected for an audit is that if you've got discrepancy with third-party information, that one is a little bit difficult to audit. If you have any misinformation, CRA always do a match between what the institution like the bank and your employer is filing at the end of the year. At the end of like maybe in the summer or in the fall, they would do a match of what they file compared to what the personal tax return filed, and they will do a cross reference and see if you've missed any information. And that is when you get a letter saying, hey, like you've missed this T5 slip that you never received, or hey, you've missed this T3 slips that you've never received. There are notable changes from the previous year. Those are standard. You're reporting rental or business losses yet again. So this is one of the things that I always work with my client on. You don't want to report multiple year of rental losses just because you don't want to get audited. Sometimes it's all legitimate. There is nothing we can do. We just know that we will trigger an audit it's a matter of time, so that you just need to be documenting everything that you do, and make sure that you write it all down and you keep track of all your receipts and all your documents. You fail to respond to CRA requests, which is the same thing. You will, if you don't respond to them and they're auditing you, they just do an assessment, their own interpretation of what the truth is, and they give you an assessment and they give you a bill. You're filing an adjustment. So this is one big thing. When you notice that you may have made an error in your prior year tax returns, whether it's corporation or personal, sometimes when you file an adjustment, they don't just give you money back, or they don't just give you the reassessment. They want to look at whether it makes sense to do an assessment. They want to see the supporting document, and these are the attributes. These 7 attributes are the reason. One of the, I guess, most of the reasons that why CRA would focus and select a particular return for audit. So next time, if you don't want to get audited, one of the things to avoid is on these lists. So make sure that you don't, make sure that you just keep all the documentation, and you will be fine. Until next time, happy Canadian real estate investing.